underscore. Diploma in English, C2 level. Module 7. Economics and Perfect Infinitives, underscore. Module 7. Economics and Perfect Infinitives. Learning outcomes. Having completed this module, you will be able to list vocabulary words relating to finance and investments. Recall the future simple and future continuous tenses. Explain the use of the future perfect and future perfect continuous tenses. Identify how to use modals for future tenses. Discuss the use of perfect modals and how to structure future sentences using perfect modals. Define perfect infinitives and how to structure future sentences using perfect infinitives. Compare and contrast perfect modals and perfect infinitives in sentences referring to the future. The economy. Watch and listen, repeat again. Economy equals the relationship between production, trade, and money supply in a particular country or region. Revenue. Money a company or organization makes from doing business. Cost equals the amount of money a company spends in order to do business. Profit equals the amount of money a company makes after cost. Profit equals revenue cost. Liability equals the amount of money that a person or company owes. Inflation equals a fall in the value of money and a general increase in prices. Deflation. A fall in the prices of goods and service and an increase in the value of money. Depreciation. A decrease in the value of an asset over a period of time. Budget. The money that is available to a person or an organization and a plan of it will be spent over a period of time. Boom. A sudden increase in trade and economic activity, a period of wealth and success. Slump equals a sudden fall in price or value by a large amount. Barter equals the system of exchanging goods, property, service, etc. for other goods without using money. Audit. An official examination of a business and financial records to see that they are true and correct. Taxes. Money paid to the government so that it can pay for public services. GDP. The total value of all goods and services produced by a country in 1 year. Inflation versus deflation. Inflation is defined as the fall in the value of money and a general increase in the prices of goods and services. There are 3 common causes for inflation in an economy. 1. When a country's government prints too much money, the value of money decreases, and you need more money to buy the things you need. 2. When the total demand for goods and services increases in an economy, the prices for those goods and services increase. For example, when more people in an economy have more money, they tend to buy more, thus causing an increase in prices. 3. When producers have to spend more in order to produce goods and services, the price for those goods and services increases. Deflation is defined as a fall in the prices of goods and services and an increase in the value of money. Deflation might seem good for the consumer because their money is worth more. But in the long run, economists regard deflation as bad for the economy since producers respond to the fall in prices by reducing production, leading to people losing their jobs or earning less money. Deflation does not allow an economy to grow. Therefore, a 2 to 3% increase in inflation is regarded as best for the economy because it allows a country's economy to grow while allowing both producers and consumers to adjust. Test. Match each word to its definition. Select the matching answers from the sentences below. Revenue. Cost. Liability. Amount of money that a person or a company owes. Amount of money a company spends in order to do business. Money a company or organization makes from doing a business. Test 2. Type the word that completes the equation. Revenue. Cost equals underscore. Match each word to its definition. Inflation. Deflation. Depreciation. A decrease in the value of an asset over a period of time. A fall in the prices of goods and services and an increase in the value of money. A fall in the value of money and a general increase in prices. Investment. Watch and listen and repeat again. Assets. Everything of value that a person or a company owns. Capital wealth or property that is owned by a business or a person and can be invested or used to start a business. Share. Any of the unis of equal value of which into which a company is divided that are sold to raise money. Principal. Financial term referring to the sum of money lent or invested on which interest is paid. Shareholder. An owner of shares in a company or business who receives part of the company's profit. Stock. The value of shares in a company that has been sold. Stock market, stock exchange. A place where shares of a company are bought and sold. Bull market. A period in the stock market in which share prices are rising. Bear market. A period in the stock market in which prices are falling. Stockbroker. A person or an organization that buys and sells for other people. Dividends, an amount of profits that a company pays to people who own shares in the company. Bonds, a legal agreement by a government or a company to pay you interest on the money you have loaned to them. Pension, an amount of money paid regularly by government or a company to somebody who has retired from work. Day trader, a person who buys and sells shares very quickly on the same day using the internet in order to make a profit from small price changes. Entrepreneur, a person who makes money by starting or ruining business, especially when this involves taking financial risk. Bankrupt, without enough money to pay what you own. In Module 7, Shares versus Stocks. Sometimes investors will use the terms shares and stocks interchangeably, which is why their exact definitions can be confusing. As an investor, it is important to understand the minor differences. Stocks shares. A stock refers to the publicly traded company that issues shares. A share is the unit of measurement of ownership in a company. Stocks can refer to the ownership of many different companies. Shares usually refer to the specific ownership stake in a company. Stock is a more general term, share is a more precise term. For example, if you want to invest in Company X, you will buy 100 shares of Company X's stock. Owning 100 shares of Company X would mean you have an ownership interest in the company's stock. On the other hand, if you buy 100 stocks, you have an ownership interest in 100 companies. So if you say, I own stock in Company X, you are saying that you have invested in Company X and, therefore, you own a small part of the equity in that company. But if you say, I own 100 shares of Company X, you are telling us exactly how many units of ownership you have. Match each word to its definition.